of the inventory account accurately reflects the value of the inventory account at any point in time within an accounting period. Meanwhile, organizations or businesses that use the periodic inventory system update the inventory account only at the end of the accounting period. This means that in the middle of an accounting period, the balance of the inventory account reflects its balance at the end of the previous accounting period. For example, if the balance of the inventory account on February 28 is 10,000 pesos, then from March 1 until March 30, its balance will stay at 10,000 pesos regardless of any sales or purchases that are completed during the month. The only time the balance of inventory will be updated during the month of March will be on March 31 at the end of the accounting period. Businesses will usually perform a complete count of inventory at the end of the accounting period in order to determine the cost of goods sold. So in this example, if at the beginning of March, inventory had a balance of 10,000 pesos, and on March 31, after counting, it was determined that the remaining inventory is 3,000 pesos, then it means that the cost of goods sold during the month ended March 31 was 10,000 pesos minus 3,000 pesos, or 7,000 pesos. This is, of course, assuming that the business did not make any additional purchases during the month and did not return any goods to the seller because of damage. Again, I'd like to emphasize that when the periodic inventory system is used, no debit or credit is made to the inventory account during the accounting period. So, how then do these organizations keep track of purchases and sales? Well, organizations that use the periodic inventory system use temporary accounts in addition to the inventory account. So, what do you think is easier to study, the periodic inventory system or perpetual inventory system? Well, because it's relatively more straightforward, the perpetual inventory system would be easier to study. There are no additional temporary accounts that we need to deal with. If that's the case, then which inventory system should we focus on studying for the remainder of the term? Well, I'm sure that because you love challenges, you chose the periodic inventory system. So, for the remaining chapters in this unit, we will be focusing on how to do accounting for merchandising businesses that use the periodic inventory system. Perpetual inventory systems are typically used by organizations that sell a low volume of high cost items such as car dealerships and jewelry shops. Traditionally, periodic inventory systems are used by organizations that sell a high volume of low cost products such as supermarkets, bookstores, department stores, shoe shops, and others. I said traditionally because many big businesses that would have used periodic inventory systems have now transitioned into perpetual inventory systems because of the proliferation of computer based information systems that allow them to easily keep track of the balance of inventory. Now that we're done with the introductory concepts, we're ready to talk about the parts of the income statement of a merchandising business, beginning with net sales. Recall that net sales is the first part of the income statement for a merchandising business. The value of net sales is a function of three components: gross sales, sales returns and allowances, and sales discounts. However, we will include in this chapter a discussion on transportation out. Transportation out is an operating expense, which means it belongs to the third major part of the income statement. Yes, you heard me right. Operating expenses is the third part because gross margin from sales is not really a section of the income statement, but just a term referring to the difference between net sales and cost of goods sold. Okay, let's look at the first component of net sales, gross sales. Gross sales consists of the total sales made during an accounting period, whether for cash or on account. Recall from Unit 2 that sales is the principal or primary revenue of manufacturing and merchandising businesses. Being a revenue account, sales will cause an increase in capital, and since an increase in capital is recorded as credits in the journal, sales is always credited. Let's look at an illustration. Suppose that a business sold merchandise worth 30,000 pesos on August 12th. Prepare the journal entry to record the sale if it was made for cash and on account. Let's consider the first case, when sales was made for cash. If sales was made for cash, then what accounts are debited and credited? Since sales was made for cash, cash will increase, which means cash will be debited, and since sales is a revenue account, sales will be credited. Now let's consider the scenario where sales was made on account. What accounts are debited and credited? Because sales was made on account, the business will have a receivable, specifically an accounts receivable. And again, because merchandise was sold, we credit the sales account. Now suppose that the customer returned defective merchandise worth 10,000 pesos on August 15. We're asked to prepare the journal entry to record the return of goods if the sale was originally made for cash and on account. If the buyer originally paid cash on August 12 and returned merchandise worth 10,000 on August 15, then cash would have to be refunded to the customer. Therefore, on the August 15 entry, we would credit cash. Now, because the customer is returning some merchandise, it means the sales of the business will decrease, so intuitively, since sales is a capital account, we would debit the sales account. The problem with debiting the sales account to record the return of merchandise is that we would lose the information that sales was decreased because of returns. All we will see at the end of the accounting period is the net value of sales, but we would not know how much worth of merchandise was returned by customers. Managers of businesses should keep track of the value of returned merchandise because a very high value of returns may mean that something is amiss with the fulfillment process of the business. So instead of debiting sales, we will debit a separate account which we now introduce. Buyers may be dissatisfied with the merchandise or goods that they received. This could be because the goods arrived damaged, or were incomplete, or were not what they ordered, or arrived way after the promised arrival date. In these cases, the buyer may return the goods to the seller, or the seller can just decrease the selling price of the goods. These returns and decreases in selling price are recorded collectively under an account called Sales Returns and Allowances. Sales returns and allowances is specifically a contra sales account, and because sales is a revenue account, sales returns and allowances is more generally a contra revenue account. Because it is a contra revenue account, an increase in sales returns and allowances should be recorded as a debit rather than a credit. So going back to our scenario, instead of debiting sales, we debit the account sales returns and allowances, which is again a contra sales account. Now, how do we record the return of merchandise if the original sale on August 12 was made on account? Debiting sales, we debit the account sales returns and allowances, which is again a contra sales account. Now, how do we record the return of merchandise if the original sale on August 12 was made on account? If the original sale was made on account, then instead of cash decreasing, the collectibles or receivables of the business will decrease. Therefore, instead of crediting cash, we would credit accounts receivable and debit sales returns and allowances. When a business decreases its receivable from a customer, it will usually issue a credit memorandum, which is, again, a formal notification given to the buyer to inform them that their account is being reduced. Recall that this is one of the source documents from our earlier list. Now, suppose that the customer on August 12 returned defective merchandise worth 10,000 pesos on August 15. If the purchase had terms 2/10 and 30, then we are asked to prepare the journal entry to record the full payment if it was received on August 23 and letter B on August 22. First of all, what do the terms 2/10 and 30 mean again? It means full payment is expected within 30 days, but if full payment is received within 10 days, then the buyer is entitled to a 2% discount. 10 days from August 12 is August 22, which means that if the buyer paid on August 23, then the buyer is no longer entitled to a discount. How do we record the payment on August 23? We will credit accounts receivable because it decreases and debit cash because it increases. Since the original sale was for 30,000 and merchandise worth 10,000 was returned, it means that the debit and credit value would be 30,000 minus 10,000 or 20,000 pesos. We can be sure that the business originally sold merchandise on account because of the presence of payment terms. Payment terms would be unnecessary if the customer had already paid cash. Now we prepare the journal entry if payment was received on August 22. Since the buyer is entitled to a 2% discount, the cash that will be received will be decreased by 2%. 2% of 20,000 pesos is 400 pesos, which means that the debit to cash would be 19,600 pesos. But this entry is problematic. Why? The debit amount is not equal to the credit amount, breaking the cardinal law of double entry recording. To fix the problem, we may think of changing the credit to accounts receivable from 20,000 to 19,600. That will certainly fix the issue about the inequality of debit and credit amounts, but it introduces a new problem. When the sale was made on August 12, the journal entry involved a debit to accounts receivable for 30,000 and a credit to sales for the same amount. On August 15, merchandise were returned, so the entry was to debit sales returns and allowances for 10,000 and credit accounts receivable for the same amount. The customer originally owed 30,000 pesos, but the amount was decreased on August 15 by 10,000 pesos, which means that the customer owed 20,000 pesos as at August 15. If accounts receivable is credited 19,600 on August 22, then it means that as at August 22, the customer would still owe 400 pesos. But the customer will not pay this amount anymore because it was supposed to be given as a discount. So reducing accounts receivable to 19,600 is not an option. To close accounts receivable, it should be credited 20,000. So what then? Well, we use a new account, sales discounts, to represent discounts given to customers who pay within the discount period. Like sales returns and allowances, sales discounts is also specifically a contra sales account and generally a contra revenue account. Again, because it is a contra revenue account, an increase in sales discount should be recorded as a debit rather than a credit. So in our earlier example, we debit sales discounts for 400 pesos. This is our journal entry for payment made on August 22. So far in this chapter, we've learned about gross sales and two contra revenue accounts, sales returns and allowances, and sales discounts. These contra revenue accounts should be deducted from gross sales in order to determine net sales for an accounting period. In other words, net sales is equal to gross sales minus the sum of sales returns and allowances and sales discounts. This is shown in the partial income statement showing only the net sales portion of the full income statement of Buja Mate. This brings us to the last topic in this discussion, transportation out. Recall that transportation out is an operating expense. Being an expense, transportation out should be debited whenever the seller shoulders the cost of transporting goods. Transportation out is also sometimes called freight out. Assume that on June 5, Buja Mate sold merchandise worth 25,000 2/10 and /30. Transportation costs amounted to 2,000 and full payment was received on June 15. We're being asked to prepare the journal entries for June 5 and June 15 with different transportation terms. We consider the first case, FOB destination freight prepaid. First of all, the journal entry for June 5 should include a debit to accounts receivable and a credit to sales for 25,000 pesos. We then observe that the transportation terms are FOB destination freight prepaid, transportation, and freight prepaid. FOB destination indicates that the seller would shoulder the cost of transportation, and freight prepaid indicates that the seller would pay the shipping company. Since the seller shoulders the cost of transportation, we have a transportation out expense. Now, how should transportation out be recorded? Since transportation out is an expense, it should be debited. Now, because the terms indicate freight prepaid, it means that the seller pays the shipping company. This means that cash will decrease to pay for the transportation costs, and therefore, the complete entry will also include a credit to cash. We now record the June 15 transaction. Since June 15 is within the discount period, the buyer is entitled to a cash discount, which is sales discount from the seller's perspective. So, the June 15 entry would be debits to cash and sales discounts and a credit to accounts receivable. The value of sales discounts was computed from 2% of 25,000, and cash is the difference between 25,000 pesos and 500 pesos. Now let's look at the second case, FOB shipping point, freight collect. How do we record the sale of merchandise on June 5? Well, we start with debiting accounts receivable and crediting sales. FOB shipping point means that the buyer will shoulder the cost of transportation, so the seller will not have a debit to the transportation out account. Freight collect means that the buyer will pay the shipping company, which means that the seller will also not have a credit to cash. So we just need to write a description and our entry is complete. On June 15, the business receives full payment from the buyer. Again, since June 15 is within the discount period, the buyer is entitled to receive a 2% discount. So the June 15 entry is the same as in the first case earlier. For the third case, we are given the terms FOB destination, freight collect. How do we record the sale of merchandise on June 5? Let's start by debiting accounts receivable and crediting sales. Now let's look at the transportation terms to determine what other account should be debited or credited. FOB destination indicates that the seller shoulders the cost of transportation. Therefore, there should be a debit to the transportation out account for 2,000 pesos. Freight collect indicates that the buyer will pay the shipping company on behalf of the seller. Since the buyer will pay the shipping company, there will be no credit of 2,000 pesos to cash. This now brings us to a problem because the sum of debits is 27,000 while the credit amount is 25,000. This discrepancy is because the buyer is paying the shipping company 2,000 pesos, which is supposed to be shouldered by the seller. Saying that another way, the seller shoulders and therefore should pay the shipping charges, but the buyer is paying on the seller's behalf. Therefore, the seller owes the buyer 2,000 pesos. So the buyer owes the seller 25,000 for merchandise, but the seller owes the buyer 2,000 for transportation costs that the buyer paid on behalf of the seller. Now later on, the buyer can pay 25,000 to the seller and then the seller can pay back the buyer 2,000, but that would require two separate transactions. So instead of doing that, we can reduce the value of accounts receivable to account for the 2,000 pesos that the seller owes the buyer. So instead of entering a value of 25,000 pesos, accounts receivable will be debited 23,000 pesos. Does that make sense to you? Instead of the buyer owing the seller 25,000 pesos, the buyer will just owe 23,000 pesos because the seller originally owed the buyer 2,000 pesos. Now, some of you might come up with the idea of just increasing the value of sales from 25,000 to 27,000 in the original journal entry. This would indeed make the sum of debits equal to the value of credit, but it would distort the value of sales, leading to inaccurate accounting data. So never adjust sales to account for receivables and payables. We complete the correct journal entry by writing the description. Now we prepare the journal entry for June 15. Because accounts receivable was reduced to 23,000 on June 5, the credit to accounts receivable on June 15 should also be 23,000 in order to cancel out the accounts receivable account. Since June 15 is within the discount period, the seller should provide a sales discount. Keeping in mind that accounts receivable has been reduced to 23,000, how much is the sales discount? it's still 500 pesos. Remember that discounts are applied to total sales and not to receivables. Therefore, the debit to cash would be 22,500 pesos. We now consider the last case where we have the terms FOB shipping point, freight prepaid. How is the June 5 transaction recorded? Since sales was made on account, we record a debit of 25,000 to accounts receivable and a credit to the sales account also for 25,000 pesos. FOB shipping point indicates that the buyer shoulders the cost of transportation, and freight prepaid indicates that the seller pays the shipping company. Since the buyer shoulders the cost of transportation, there would be no debit to the transportation out account, but since the seller pays the shipping company, we would credit cash the amount of 2,000 pesos, representing the amount paid to the shipping company. Because the seller is paying the transportation cost on behalf of the buyer, there is again this inequality between debits and credits. How should we resolve this inequality? The buyer already owes the seller 25,000 pesos for merchandise, but on top of that, the seller pays 2,000 pesos to the transportation company, which is supposed to be shouldered by the buyer. Therefore, accounts receivable should be increased to 27,000 pesos. We complete our journal entry by writing the description. Now, for the June 15 transaction, we debit cash and sales discounts and credit accounts receivable. How much are the values debited and credited to these accounts? Accounts receivable should be credited 27,000 pesos to close the accounts receivable account. Sales discount should be debited 500 pesos because discounts are computed from sales and not receivables. This means cash will be debited 26,500 pesos. This ends our lesson on this chapter, net sales. In the next video lesson, we will look at the other two sections of the income statement, cost of goods sold and operating expenses. In the meantime, if you have any questions, please let me know. I'll see you in the next video.